G'day, fools. I'm Scott Phillips from the Motley Fool, our Chief Investment Officer, and welcome to the very first day of what is going to be, I'm sure, a wonderful week. We're talking financial literacy. Now, that phrase can kind of be, it feels a bit over the top, right? What are we trying to do? We're trying to help give some detail, some definitions, some language, and some skills around getting your finances in order. Whether you've been investing for 50 years, whether you've never even started, whether you're deep in debt or you've got a pile of savings ready to go, we are going to try and help you take control of your finances. That's what this week is going to be all about. 5 sessions, one today, and then through the rest of this week at this time, finishing with a masterclass, as we're calling it, and a live Q&A, question and answer session, where I'll take as many questions as you can throw at me within our allotted 1 hour of time. Now, a couple of things. Firstly, there's a message thing at the bottom here, over the side probably. Use that if you want to throw any questions in. I can't promise I'll get to them all today. If they're not kind of about the topic I'm talking about, we've got people at the Fool who will take those down and we'll bring them back to the surface on Friday. There's another bonus for tuning in. But if you have questions about what we're talking about today, if it's relevant, if I don't explain something well, if you have one of those light bulb moments of, yeah, but what? That's what that's about. So if you've got any questions, just want to say g'day. G'day, hippie happy, and to Michael Rigg. Hopefully, Michael, you've worked out how to view the event because we're live now. So I'm hoping you're there and enjoying the session. If you are, that's fantastic. Come and say g'day. If you're anyone else coming to say g'day, just drop a hello in the chat. If you want to do that, we can chat interactively. Now, let's do a couple of things up front. Firstly, the Motley Fool provides licensed financial advice. That means you can trust us. It also means that I need to be clear about what I can and can't say. Everything I say today will be general advice only, not personal advice. That is not tailored to your circumstances. Even if you ask me a question directly and say, hey, what should I do? I will say some version of, I can't tell you what you should do. I don't know enough about you and your circumstances. I'm not even allowed to without filling out a full statement of advice, really detailed, complex stuff that we don't do at the Motley Fool. We don't offer that. That's the role of the personal financial advisor. So anything I say will be general financial advice only. That's really, really important as we kick off from the top. The second is we've got a whole week's worth of stuff. We're going to do things in some sort of rough order and try and give you the best we can deliver here from the Motley Fool and from their expertise that we've put together. In terms of the series, here, let me tell you what we're going to go through. Day one, that's today. We're going to talk about mindset and overcoming money myths. Tomorrow, budgeting and dealing with debt. Tomorrow is the broccoli. Tomorrow is the eat your broccoli session, right? And I really want you to come back and make sure you spend some time with us doing that. Why? Because if you don't get that stuff right, you can't move to the next step. Plenty of people say, how can I save more? How can I invest? How can I take control of my financial life? But I don't really want to talk about debt or budgeting. I'm going to try and make it interesting. I'm not going to do not going to make it too over the top or too detailed. I'm going to try and give you some skills, some tips, some techniques, some opportunities and abilities to take advantage of your financial life. That's what we're going to do tomorrow. Getting your debt under control is really, really vital. If you've got it under control, staying out of debt, equally important. There's some good debt. There's lots of bad debt. We'll talk about that. Day 3, Practical Investing 101. We're going to try and break down some barriers, right? Investing feels really weird, scary, hard, uncertain, foreign, whatever phrase you're thinking of right now. Feel free to throw those at me too. We're going to try and talk a little bit. G'day, Evan. Thank you for saying g'day. We're going to try and throw in a whole lot of content around how to think about investing, learning about investing so you feel more comfortable when you get going. I will tell you up front, here's something I'm going to say. By the way, I'm looking down at my computer, which is down here. My screen for my camera is over there. So if I look around, I am paying attention, I promise. I'm just looking in different places. Practical Investing 101 is to get you ready to go. And the best analogy I can use is internet banking. Actually, maybe not. Maybe only if you're as old as me. I remember there was a time before internet banking. In fact, I remember the very first FBOS machine I saw. That's how old I am. But yeah, internet banking felt scary, right? I put my password in. What do I do here? Any new software, any new thing you do feels weird. Once you've done it a couple of times, opening a brokerage account, transacting, buying and selling shares, really, really, really simple. So please don't be put off. And we'll talk a little bit about that on Wednesday. On Thursday, one of my favorite topics, long-term returns. I'll talk about that regularly, I'm sure, this week. The power of investing is in time, capital T, time. Yes, we want to maximize our returns. Of course we do. But there's nothing that can replace time long-term. And by the way, if you're 50, 55, 60, 65, 70, and you think, I haven't got any long-term left, well, guess what? You're probably going to live till you're 90. You got heaps of time left. So please don't think time is only for the 25 and 35-year-olds. I'd like to be 25 or 35 again. I would pay a large amount of money for that opportunity. But absent that, you, no matter how old you are, have got in all likelihood decades, multiple decades, hopefully, ahead of you, of which time your money can compound and compound meaningfully. So take advantage of that. I just realized I haven't changed my speaker outputs. I'm going to do that right now so it doesn't bing if you heard that noise. My apologies. So that's kind of what we're going to do on Thursday. Then on Friday, I've already talked about the masterclass. Basically, the idea is we're going to recap what we've talked about. We're going to hopefully give you the skills and ability to go and take what we talk about and use it, make something of it, as well as give you the chance to ask lots and lots of questions about what we're covering. So, again, as I said, by the way, please throw your comments and questions in. I'm going to talk about what I've got to talk about. I say this to our members all the time. When we do videos, we say, well, here's what we want to talk about. So we do. And hopefully it's useful. Hopefully it's educational. Hopefully it's actionable. But if you've got stuff you want me to talk about, questions you want that fit in this kind of framework, please let me know, because that's how this works, only if we do that. Let's get started. I want to talk first about this is myths and mindset, right? Let's talk about mindset first, because it's how you know what? It's a cliches are funny things. Why is a cliche a cliche? It's a cliche because it's true, and it becomes a cliche because it's said so frequently. Now, maybe there's some untrue cliches. I suppose there must be, but largely they become cliches because they're those truths, those hopefully self-evident truths, or at least identifiable, observable truths. That once you hear them, kind of remain a constant. And I say it to you, you say it to me, everyone says to each other, and all of a sudden you go, oh, that's so cliched. Sometimes cliches are useful, right? Because it tells you that these things are true enough that people have said them regularly. Now, plenty of old wives' tales, or whatever we call them these days, but yes. So just keep that in mind. Mindset, though, is really what it's about. And I want you to know, back to the proverb, the journey of 1,000 miles begins with a single step. And I hope today, for at least a few people watching, this is that first step. Why? Because I get that, I want to retire with $1 million. That can feel like it's someone else's life, someone else's future, someone else's retirement. I can't promise you can do that. If you're 85, still working, you got $14 to your name, I probably can't make you $1 million, right? If you're young enough, you can add and save regularly. If we can help you think about how to invest that money regularly, and you do it for long enough, you can get pretty close to that number. Now, maybe not everybody, maybe not all the way, but let's make that aspirational, right? My point is, whatever stage you are in life right now, if you can find a way to save a buck. Now, again, plenty of people doing it really tough right now, saying, I can't do it. And if that is you, if you genuinely can't, not if you're pretending you can't, that's a mindset thing we'll talk about. But if you genuinely can't save any money, I want to tell you now that I hope in time, this stuff will at least stick in the back of your mind. And when you can get to that point, you'll be good to go. And at least you'll think, that's right. I can go back. By the way, this will be saved on YouTube. I can go back on YouTube and I can find some of that stuff. I can be part of that conversation. I can start to invest. So I hope that's some of you, hopefully not too many, but there's just people out there who just can't save a buck, right? They can't do it. For the rest of us, we can find a way to save some money. And what's going to stop you up front is the I can't do this. Now, what's this? It depends. For everybody, it's different. I can't cut my spending. I can't save any money. I can't invest. It's all too hard. I've tried it before. It's like weight loss, right? How many times have we all, well, me personally, started a diet? I haven't quite got there. I get it, right? But you've got to believe that you can. Otherwise, the rest is useless. If you're watching this going, well, it's right, fine for you to say, Phillips, I can't do that. I bet you can. But you have to believe that you can. And I want you to look around, right? There are some spectacular stories. I'm not going to bring you the apocryphal stories now. Some of them are real, by the way, of the US hospital janitor who dies and leaves an estate worth multi-million dollars. Not because they were super high earning, but because they were just frugal and saved and did the right thing. And here's the thing. You don't have to, this is, by the way, investing 101. You don't have to save $1 million to have $1 million. Now, if that sounds weird to you, welcome to compounding. You can save a little bit of money regularly enough and add that up and add that up and add that up. We'll talk about this in the next couple of days. And you can create those sort of amounts of wealth. Just putting some money aside once. Here's a stat. I'm gonna steal from the future because I'd like to do that thing. Vanguard is a great fund manager, though not for profit. They've got this great, it's index chart, they call it. It's a 30-year chart. And on the chart, the little squiggly line goes up and to the right, unless I'm in reverse, in which case it's going that way. But whichever way you're watching it, think about up and to the right. If you invested $10,000, now pick a number, just call it $10. But let's go with 10,000 because that's their number. If you invested $10,000 30 years ago, 30 years later, this was as of 30 June last year, That 10 grand over 30 years became $130,000, right? Now I'm just going to do the maths just for fun. Let's say you want to get to $1 million at the end. You need to start over 30 years. You've got longer than that for most of you, hopefully. If you want over 30 years, you're going to start with $80,000. Now, that sounds out of reach. So don't focus on the money, except that. That 80 became $1 million. In other words, $920,000 worth of value you didn't have to save. You only saved the first 80 grand. Now, I know it's a lot of money to save 80 grand. So let's call it 8 grand to $100,000, right? Let's call it $8 to $100 if you need to. The point is, you don't need to save most of that. You need to save a little bit of that kernel, the acorn that grows into the oak tree. Let's grab another cliche. You need to save the acorn and plant it and let it do its thing. Now, hopefully for most of us, we can add money regularly over time, not just one-off 30 years ago, but regularly over that 30 years. And the number gets bigger and bigger and bigger. And honestly, they are the numbers you can get to. And it depends on the assumptions, right? How much you can save, how frequently, what sort of return you get. Trust me when I say, let's just use the Vanguard example. You put money in once, you didn't touch it at all, ever, forever after that. You forgot about it. You went fishing, swimming, played with the kids, played with the grandkids. And someone knocks on the door 30 years later and says, you know, that 80 grand you put aside, that's worth $1 million today. And you go, how did I just make $920,000? And the answer is long-term compounding. My point, you can do this. It is not as hard as you might imagine, but you have to believe you can. If you can save $1, you can invest that $1. If you invest that $1, you can make another $1, another $10, another $100 on top of that. Investing well in the right companies, the right investments, and letting time do the work. You can do this. I've seen it done. I've done it myself. Plenty of people around done it. I wasn't born with a silver spoon, by the way. I'm the son of a fiery and a nurse. I happen to be born with good genes, not again, my credit. I was born with them. That makes me good at finance stuff. Finance tends to be a pretty good career that rewards pretty well. So I'm not saying I didn't dig up the money myself. I've earned pretty well over my career, but I didn't start with a trust fund. I've built my wealth over time by regularly investing well. Something very quickly to check in the heuristic. I like that. Thank you, Evan. Cassandra, which says superannuation covered, transition to retirement. Cassandra, we're not going to do transition to retirement. I'm going to disappoint you right now. That is personal financial advice, and the accounting stuff on that is really, really detailed. Not overly difficult. It's not hard to do. Jump on the ATO website. I might try and pull a little bit in if I have some time. Maybe let's do that. I'm not planning to cover it in detail. It's not relevant for most people. I'm trying to make this pretty general. There's some good information from the ATO. You can grab that. Dave, why invest directly in shares? Love it. I will answer that later in the week. Very, very good question. By the way, whether you invest directly in shares or invest in shares using your super, you're still investing in shares, right? So there's the structure, and then there's the assets, or the asset class in this case. Asset class are, I was going to say words I probably shouldn't say on YouTube. It's a fancy way of saying the type of investment you make, right? I know you know that, but for anyone listening or watching, it's about, so shares are an asset class, right? A group of companies that have the same thing. But I don't disagree with you. We'll talk about maximizing superannuation later in the week. Evan, 80 grand, bought a house. Yes, it did buy a house 30 years ago. Here's the other thing, by the way. I love that point you make. The key point really isn't whether or not bought a house. The key point is now worth $1 million. Now, you can say it's not enough, it's not as much, could have bought a house. My point is still you'd have $1 million if you've done it. And that's kind of the Kurt, I mean, that dismissively. That's the key to what I'm saying here, right? It's like, what would be, here's the other thing. If you invested 80 grand 30 years ago, you got $1 million today. You didn't do it 30 years ago, you got nothing today. So invest anyway is kind of my key point. But I take your broad point, mate. Property's done very, very nicely over that period of time. I doubt 30 years ago, by the way. I mean, it depends on what house or where you were. My parents built a house and land package for, I think it was 38 grand in 1978. So yes, I understand your point. It's a little more than 30 years ago, by the way. So yes, there are opportunities to invest in different asset classes. We're not going to cover a lot of that. We're a shares company, and here's the thing: I'm a shares guy not because I work for the Motley Fool. I work for the Motley Fool because I'm a shares guy. In fact, so a bit of very quick pot of history. Back in 1998, it's a very long time ago, I was reading the newspaper. For kids watching, there was a thing called a newspaper. It was printed on newsprint, and you got newsprint on your hands. Remember that? For the old people amongst us. And I saw things about the Motley Fool. And I won't do my whole story. I've been at high school, economics teacher who was great, did commerce at uni, first job out of uni, doing my thing. And I see this thing called the Motley Fool, and I can't start reading about it. And so I learned about shares. Now, by the way, I didn't join the Motley Fool until 2011, so a long time in between. But I learned about the idea of investing from the Motley Fool. I learned about the power of shares. I invested in shares. Sometime later, the Motley Fool opens in Australia. I turn up here and say, hey, can I have a job? I like what you guys are doing. I want to help Australians the way I was helped by what was then only the US business. We had a US website, and I learned all my stuff from there. So yeah, could you buy a property? Yes. Could you buy other assets? Sure. I'm a shares guy because I think the opportunity for shares being diversified, long-term growth, dividends, franking credits, by the way, we might touch on that later in the week. That's why I'm a shares guy. But if I had a great property investment opportunity, would I take it? Absolutely. If someone sold me a cheap Picasso, would I buy it? Yeah, absolutely. I think shares are probably the best way for all those reasons to get your financial house in order and to build some serious long-term wealth. I think there's three key elements to investing. I'll get back to some of these other questions in a minute. Three key questions for an investor, or three key attributes is probably the better way to put it. And what I want to talk to you about is three things: patience, discipline, and emotional control. And they are really, really important. They are, if not the three, they're certainly three of the ways or three of the things an investor needs to embrace. And I also want to tell you that investing is not difficult, right? You need to do it. The thing you need to do. Investing well is a skill. Warren Buffett invests better than I do, as much as I'd hate to admit it. His investor letter was out on the weekend, by the way. Another great read. Buffett's a great investor. He invests really, really well. I'm not Warren Buffett. I don't need to be. I can build a very, very, very nice nest egg being an inferior investor to Warren Buffett. That's completely okay. That's fine by me. You don't need to be a super investor. You don't need to be. Here's the other thing: you don't win investing by coming first. You win investing by retiring with a nice nest egg. So I say everyone can win. Lots of people can win because winning is not really, it's not a race. It's not a race. We've heard that before. Let's stay away from the politics. Investing is not a race where the first person wins. Now, the person who comes first is going to have more money than me. Maybe I finish 8,000th or 25,000th or 48th, or it doesn't really matter. I'm going to retire with a very large nest egg. Not very large, as in, I'm not buying cruise liners, and I'm not going to buy James Packer's yacht from him. But I'm going to retire very nicely, not because I won investing, because I need to win investing, but because I can do the Aesop: slow and steady wins the race, the tortoise and the hare. That's how it works. So let's talk about it. Patience is allowing time to do its job. I just talked about the fact that investing is a multi-decade horizon endeavor. And I got a 12-year-old. He can't think about being 13, let alone being 33, let alone being 63, right? That's because his frontal lobe is not fully developed, and that's not his fault. The rest of us, I won't say it's your fault. What I will say is it's our job to say, if a thing can be done, that thing is worth it. Whether you want to bake a cake for 30 minutes, you put something in a loaf of bread for 4 hours, you put it in, you wait 4 hours, it comes out. You don't check it every 25 minutes. You don't prod it again and see how it's going. You let it do its thing. I'm a very bad amateur gardener, amateur vegetable gardener. You want to grow some peas, the thing starts up that big, and then it's that big, and then it's that big. And you can't plant 15 peas and have them all, they're not going to get peas 15 times quickly just because you plant more of them. Now, planting more of them means more peas eventually, but you have to let time do its job. Apple tree, lots of analogies. My point here is patience is the only thing that matters in investing, because without it, you don't get to the end of the race, right? Again, I talk about being a race, call it what you want. There's probably a better analogy out there. If you've got to do a certain distance to get to the end of whatever it is, wherever you're going, right? I'm going to walk from here to wherever. Getting there, it doesn't matter if I stop at any point between here and there, I don't get there. If I wait and do the work and are patient, I say, I know I'm going to get there. I'm just going to have to let the thing play out. Then I get there. If you're a creator, if you've built a business, think about the great businesses of the world. Woolies in 15 or 12 or something, when it first started, it's now 1,000 supermarkets. It's worth billions of dollars. If the owner had given up on week 3 and went, I've only got one store still. I want 1,000 stores eventually. I hope you get the point. You've got to be patient. Now, these aren't just motherhood statements, right? These aren't just me saying, well, here's what patience looks like. This is about being patient in the journey, because you've got to get to the end. That's the only way compounding works, right? Is by being there at the end. Really, really important. Second is discipline. That's a function of patience to some degree. And it is doing the right things at the right time because of the right things to do. Now, people say character is what you do when no one's looking. Discipline is how the investor gets to a decent sized nest egg. So patience to get to the end. We'll just talk about that. Discipline of doing the right things to get to that point. Now, it is spending less than you earn. It is saving that money regularly. It is investing that money regularly. It's seeing these things happen and saying, this is how I'm going to invest. Just because my mate's getting rich playing some dodgy crypto coin doesn't mean I'm going to start doing it as well. Just because the guy on the other side over there is going on a nice holiday, well, I'm investing my money. I'm thinking, gee, I'd like to do the overseas holiday this year, but I haven't got the dosh. Again, being disciplined, seeing your plan through. There's the old line about, Mike Tyson. Everyone's got a plan till they get punched in the face. Investing is getting punched in the face sometimes, and more often than not punching the other guy, but seeing it through to the end. You've got to be there. You've got to be disciplined enough to get that job done. And then emotional control, again, these are interrelated topics, right? Emotional control is being able to say, I'm losing money, and that really, really sucks. I'm going to give you a really recent example. Well, it's thankfully a few years ago now. Or actually, in fact, it's almost exactly 5 years ago. So the COVID crash, the share market fell 38%. And I want to say it was the 20th of Feb to the 28th of March, something like that. I forget the numbers. A month and 4 days, I remember something. I can't be exactly there, but there or thereabouts. The market fell 38% in 1 month and 4 days. 38%. Now, that feels like a big number. It is. If it doesn't feel like a big number, $100 went to $62. There would have been people there with a $100,000 share portfolio that saw $38,000, the price of a new car, evaporate in a month. There are people out there with $1 million portfolio who frankly got some good problems, but they saw $380,000 just disappear, puff of smoke in a month and 4 days. Some people watching right now are saying, "See, I told you investing was stupid. Who wants to go through that?" The answer is no one wants to go through it. By having gone through it, the last maybe 8, 9, 10 days ago, the ASX 200 was at an all-time high. In other words, if you'd invested even on that day, the $100,000, you lost 38 grand. Poof, gone, month and 4 days. You went, well, this investing thing sucks, but I know I've got to stick with it. You are now back to well over where the market was before that crash started. And that's the point. That is what it's about, to say I'm going to have emotional or exercise emotional control. It sucks. It hurts. By the way, I've been doing this for a long time now. It's longer than I should admit, but I had hair when I started, put it that way. I've been doing it for a long time. It hurt. I'm not. Here's the thing: you don't get through these sort of crashes and go, those crashes don't hurt anymore. I don't care about losing 38% of my wealth. That's fine. Who cares? You absolutely care. Trust me, you care. And I cared, and I hurt like buggery. Because no one likes losing money, right? And you start to think, what if the market's right? What if they know something I don't? What if this is the end of the world? What if? And plenty of people at that point got scared and sold. Those are the ones who went from 100 to 62 and then took out 62 in cash, and they're still there. Other people said, that sucks. That hurts. I hate this. I want it to stop. Please make it go away. But I'm going to separate those feelings from my actions and say, I'm going to make it through. That is where you separate those who will be successful long-term from those who will not. And again, remember, I'm not saying you need to make it stop hurting. I'm not saying you need to be at a point where, if those are Star Trek fans out there who like Mr. Spock, you don't have to be a Vulcan. You don't have to be an emotionless, feelingless human being to get through those sort of things. What you have to do is be able to separate the emotion from the decision. This sucks. This hurts. I don't like it. Make it stop, but I'm going to see it through. In fact, I had exactly that. That was exactly my emotion. Exactly my emotion. And you know what I did during the COVID crash? I bought shares. Not because I'm a genius, not because I knew the market was going to rebound or I was picking the bottom. I just kept buying because I had cash. I save regularly. I save monthly, and I invest monthly where I can. Most months. That's how I go about my investing. So I went, this is awful. I hate this. I don't want to do it, but I know that over time the market has always gone up and will probably always go up, in my opinion. Certainly, we're not at the peak capitalism yet. And if it's going to go up or forever, with bumps and jumps, it'll fall and rise and fall and rise. If it's going to be higher in 3, 5, 10, 15, 25, 30 years' time, we just talked about that time, why wouldn't I invest now? Even though it sucks, even though it hurts, even though I don't want to do it. And that is the emotional control. Add it to your discipline, add it to your patience. They are the 3 things you need to do as an investor, but why those 3 things are absolutely and totally worthwhile. Really, really important. I want to talk about the opposite of those 3 things. And that's getting rich quick. Before I do, I'm going to check what we got here. Evan's comment. Thank you, Evan. Nastaran, I'm sorry, I don't pronounce that correctly. You guys going back and forwards, which is lovely. All right, you guys are good. Yeah, Evan mentions the Buffett line, which is a little less, I don't know how appropriate it is these days, but yes, Warren Buffett said you can't get 9 women pregnant and have a baby in 1 month. You've got to wait 9 months either way, right? It's a nice little pithy line. I'm not sure how appropriate it is these days, but anyway, 9 women can't get themselves pregnant and have a baby in 1 month, maybe put it that way. The average is still the same, by the way, but it doesn't happen. It doesn't work that way. All right. Get rich quick is not, and it sounds obvious, right? It's not the answer. I think we all know that. And this is the Aesop tortoise and hare thing. I've only realized relatively recently that successful investing can be boiled down to 3 words. Aesop was right. It's kind of it, right? Tortoise and the hare. Now, everyone knows deep down you can't get rich quick, right? You kind of know that. Every now and again, you see someone who wins lotto, or someone who, I don't know, happens to stumble on some lucky thing, whatever, buy a lucky share or whatever, right? You go, oh, I wish I was that person. I wish life was that easy. I want life to be that easy. If I close my eyes and wish, no place like home, no place like home. Alice in Wonderland, Wizard of Oz. You've got, it's so tempting to want to believe that. But I think deep down we kind of all know there's no such thing as getting rich quick. What tends to drag us down that line are 3 things: greed, envy, and desperation. Greed is just, I want to believe it's true because if it was, then I could get rich quick. And if I was rich quick, I'd be really happy. Get it? Envy is what I talked about back then. That other guy won lotto. That other guy picked some speculative mining stock that went from 1 cent to $1, and he got 100 times his money. And gee, I wish I'd get the next one of those. Maybe I'll buy another 15 of those in case one of those does the same thing. And the desperation is kind of the saddest of the 3, because it is kind of like, my finances are in such a dire state right now. I'd need to win lotto because that's the only choice I've got. For some people, that's still true, and that's awful. For most others, it is not true. It just feels like that. Maybe it's a grind. Maybe life kind of sucks. You haven't been able to get ahead financially, and you're like, okay, I'm just giving up. I'm going to do that. By the way, that's kind of the situation a lot of our kids are in these days. There's a lot of young people buying crypto coins because they're like, well, I can never afford a house, so I'm just going to punt on crypto and see if I can make a fortune. Now, they're probably not going to. In fact, statistically, they're not going to. There's some stupid number of crypto coins out there. There must be, I don't know, 7,000 was the last number I saw. I don't know, half those probably broke by now, but there might be another 4,000 coming. So maybe there's more these days. Hope springs eternal. Desperation / greed / envy springs eternal. It's not just about crypto, by the way. It's just a good example because there's where there has been some money made on Bitcoin, everyone's trying to emulate that and get the next Bitcoin or the next Fortescue Metals, the next CSL, the next Woolworths. It's the same thing across the board. There is no such thing as getting rich quick, at least not reliably. And here's the thing: just because someone does a thing, unless it's reliable and repeatable, then it's not really a thing. If I win lotto, you shouldn't buy a lotto ticket because I won lotto, right? That doesn't work that way. And yet in investing, sometimes we kind of think, oh, so-and-so made money doing this thing. Maybe I should do the same. What you've got to work out for yourself is what they bought and how they did it. Are those things reliably repeatable? Is it likely to happen for most of the people who try the same thing? I win lotto. Most of the people who watch this video are not going to win lotto. I didn't win lotto, by the way. I wish I had. Just because it's possible doesn't mean it's reliable or repeatable. Doesn't mean the odds are actually in your favor. Getting rich quick simply does not work. Please keep that well and truly in mind. We're halfway through the session. So if you've just joined, thank you for doing that. We are going to spend another half an hour and then 1 hour every day this week, Tuesday, Wednesday, Thursday, Friday, covering Financial Literacy Week. Some of the things I think are worth knowing and really, really kind of getting deep in the gut, right? Those are things I want you to internalize. That's what we're going to spend the next 4 days doing. I've said at the beginning, I'll say one more time, I can't give personal advice. This is general advice only, but I would love you to comment. If you're watching, throw us a comment, say good day. If you've got any questions that pertain to what we're talking about now, chuck them in. If they're relevant to now, I'll take them now. If not, the team will pull them aside and put them in a document somewhere, and we'll come back to those, either as we go through the week, if they're more appropriate when we get there, or at the end of the week on Friday when we do our Q&A. I hope this all stream's working okay too. It seems to be keeping pretty well, so hopefully it's all good. Again, I said when I started, my camera's over there, my computer's down here, and the screen for the camera is over there. So when I look in different directions, that's what I'm doing. All right, I want to talk about the power of long-term thinking for you. Again, think about mindset, right? Getting your mindset right. We'll finish, by the way, with some myths. That'll be fun. Some of the things that people think are not necessarily true, at least in my opinion. There's some research out there that somewhere between 80 and 90% of day traders go broke. Not don't make money, not lose a bit of money, but wipe themselves out from their investment portfolio, not necessarily their personal lives, but wipe themselves out, go to zero. Now, if we invest $100, we want to get to 200. That's what we want to do. If you're really unlucky, maybe you invest 100, go to, say 100, go to 90 or 80. Most day traders end up at zero. And when I say most, I mean like the overwhelming majority. Let's go to some research. The research is a little bit old now. I very much doubt it's changed because neither has the stock market. So assume that's probably close enough to true. If it's not, it's directionally true. I promise you that much. Not allowed to promise anything. As a holder of financial services license, we can't make those promises or guarantees. That's one I can make. I promise you, things haven't changed directionally since that research was done a few years ago. I want to talk to you about why it doesn't work. And it comes down to why investing actually does work. Day trading doesn't work. Investing does work. Investing, by the way, we say long-term investing. The Motley Fool's co-founder, David Gardner, has said to his entire staff, if anyone ever hears him use the phrase long-term investing, other than to decry it, they can give him a dead arm. That's the way he rolls. His point is investing is long-term by its nature. In the short term, you're speculating or trading. In the long term, you're investing. Now, I don't mean those words necessarily be pejoratively loaded. They kind of are a little bit. But investing is long-term by its very nature. You are taking a long-term view on a business. And we'll get back to the business and the business of investing probably tomorrow. But you're taking a long-term view. Now, here's the thing. I've already talked a couple of times. If I don't say $10,000 or $130,000 at least 15 times in the next week, I will be very, very surprised. The Vanguard chart is so incredibly powerful. I don't know if I can put a picture or a video up here, an image up here. Maybe I can. I think I can. So maybe tomorrow or Wednesday when we talk about investing, I'll grab the Vanguard index chart. In the meantime, just Google it. It's fantastic. The creation of value over time on the share market is nothing short of astonishing. The average return per year since about 1906, I think it is, based on some Credit Suisse data, is about 9% a year. They say 6.6% after inflation. So add it back in, 9-ish%, give or take, right? And again, we can quibble over the 0.5% here or there. The reality is if you compound anything at somewhere between 8.5% and 9.5% for 118 years, 119 years, you don't have to worry about the 0.5%, put it that way. So for 100 and whatever that is, 19 years, investing in listed companies on the world's stock markets, including Australia and the US in particular. In fact, they were the top two markets. We actually won. If you want a bit of Australian pride, Credit Suisse did this stuff, I think it was 2 years ago. We were the top performing stock market since 1906 to, I think that's what it was anyway, to 2024. Really, really cool. I mean, again, I didn't do it, you didn't do it, but it's kind of nice, bit of flag waving, bit of national pride. So we've done better than anybody, and the Yanks came second. Over that period of time, massive amounts of wealth have been created. If you compound anything at 10% for 100 plus years, you have created stupid amounts of wealth. And that's kind of the point. So long term, businesses create value. Why? Because people like making money. They like solving problems. They like meeting needs. And often they do those things in corporate structures. Think about Apple invents the iPhone. I've got an iPhone, I've got an Android phone, but same kind of thing, right? I used a BlackBerry back when there weren't touch screens. I used a Nokia back when there weren't Blackberries. You had to press the same button 3 times to get the letter C. People found better and new ways to provide communication, information, access. Think about any invention. The Tesla, the photocopy machine. Well, let's make it really, really simple, right? Internet streaming, internet banking, we've already talked about. The things that get created by these companies. Why? Because there's an opportunity for someone to make some money, solve a problem, meet a need, whatever it is. Now, I don't reckon that's stopped anytime soon. In fact, I don't reckon we're at peak capitalism. I reckon there's more to come. Now, I say capitalism, some people don't like the word. I like the word because it doesn't mean what they think it means. It means just a system where we have an efficient allocation of scarce resources, right? I make a thing, my boss buys the thing from me, my labor. I use that money to buy from someone else who makes it because I want to buy it. People are prosperous as a group. Yeah, we can fix it. We can, there's got some rough edges we should round off. I'm the first person to say that, but it works, right? So are we at peak democratic capitalism? I don't think so. And if we're not, doesn't mean more value is going to be created in future. Yeah, I reckon it does. So that's my starting point. The good news about that is for investors as a group then, and let's use a gambling term for the fun of it, investing has a positive expected future value. In other words, $1 now is likely to be worth more than $1 in 10 years' time. As a group, for investors, for the stock market as a whole, so if I sell you my shares, you sell me your shares, on average, the average company is going to be worth more in 10 years' time than today. We're all going to make money. Now, not everyone. Someone will buy a dud stock. Someone will sell out after that big loss on COVID. There'll be times when we won't make the money we want to make. But as a market as a whole, we'll talk about diversification later in the week too. As a market as a whole, we will create massive amounts of value. Investors as a group will benefit from that value being created by those companies. Think about day trading now. How much value was created by Woolworths in 6 trading hours, between 10 a.m. and 4 p.m. Sydney time? How much value was created by Woolies? No, I mean, yeah, literally some, but fractionally. one 365th of the, not even that, like 6 hours out of what they're probably open 18 hours a day, Woolies. So a third of a day of a year's worth of profit creation is created in one single day. But you're not even getting that. If you're day trading, you're saying, I bet the price of Woolies is higher at the end of the day than at the beginning. And I'm going to ask you, how can you possibly know that? But also, here's the thing. The person betting against you, because it's a two-way deal, are betting the opposite. And then, so there's a zero expected outcome, right? I win, you lose. You win, I lose. That's not a great way to kind of, as a group, that's the problem with day traders, right? They're all trying to do the same thing. They're all fighting over the scraps of effectively nothing. A third of 365th of a day's worth of value creation for Woolies, which may or may not actually be reflected in the share price. Now, you see the brokers love day trading, right? Why? Hey, here's the thing. Brokers love day trading. Why do they love day trading? Not for the wealth created, but for the fees they can charge. If I buy shares once every month, right? 12 transactions a year, I'm paying $19 a trade, call it 20, make my maths easier. That's $240. They're only making $240 out of me a year. It's good business, but it's not great. What if I was a day trader? What if I was going to put a position on, let's say, I'm going to be really, really generous. Let's say 2 positions a day. And let's say the market's open 500 days a year, 250 days a year, right? So 250 days a year, twice a day, I'm spending $40, $250,000. All of a sudden, the day trader is worth a lot more to those brokers than I am. That's why you see the ads with the person at the beach with the computer in front of them, tapping away and looking at charts and all sorts of stuff, because it's glamorous. You might make some money. They appeal to our egos. It's all great. I mean, we all, again, think about greed. We want to believe, right? If it could be done, I would do it. I'd go sit at the beach and day trade. Of course I would. Why don't I do it? Because I don't reckon it can be done reliably and repeatably. We talked about that before. And the numbers back me up. I'm not even guessing. The numbers back me up. The beautiful thing is, and here's why it really matters, you don't have to play that game. The long-term wealth creation is one of the 15, 10 to 130 grand, $1 to $13, pick whatever number you want to use. I'll go 10 to 130, so that's what Vanguard used, was created. You know what the person had to do? They had to call their broker on July 1, 1994. Say, hey, that's probably a bloke. Hey, mate, can you please buy me 10 grand worth of the market index? We'll talk about that in a minute, but just 10 grand worth of ASX listed companies. Proportionally, but we'll get to the details of diversification indexes later. 10 grand. Just buy me 10 grand's worth, please. Here's your brokerage. Now, 10 grand worth of trade might cost you $20, $30 in brokerage. So you pay that, right? Here's my money. And then he says, well, what do you want me to do now after that? Nothing. Okay, he calls you back next month. What do you want me to do? Nothing. Next year? Nothing. 30 years later, he calls you and says, mate, I'm about to retire. No, do you want to make a trade yet? 2024, and you go, no, I don't really want to, but while I've got you, how much did I make? And he says, well, 10 grand's worth $130,000. And you kind of go, okay, that's kind of cool. I like that. I did exactly nothing. That's the point, right? Back to ASOP. What I say you don't have to do anything. I don't mean you have to do anything. You have to do nothing. You have to leave it alone and long-term do its job. Now, if you own individual shares, there are times when you want to buy and sell because there's value offering or you're being paid too much, the company sucks. Their individual shares are different. We'll get to that later in the week. But as a group, as investors as a whole, the long-term creates value. I'll say very clearly, the short-term destroys value. Why? Because not only is there no value creation in 1/3 of 1/365th of a year, but you're paying for the privilege of getting no value out of it, which is why, well, it's why the brokers make money and you don't. Here's the other thing. Once you get into that mindset, what do you feel? What does that sound like? Sounds like someone at the dogs or the trots or the races, right? I don't mean to be pejorative about it. You can go and have fun at the horses and put $50 on 8 races during the day and make you $15 or $20 or lose all your money more likely and go home and go, that was a worthwhile day. If you're a day trader doing this in out all day, aren't you just gambling? Aren't you speculating? Aren't you kind of just getting sucked into the idea of, I'll make it back. I'll double my bet now. I'll make that money back. I lost money over there. Let me try again. Let me try again. I'm talking about the share market having a positive expected value. If you're in a zero-sum game with somebody else, but the broker's taking money out of you both ways, yeah, that's right. It's like a bookmaker. They get their cut, and you guys just fight over the scraps. By the way, if it was an even mix, then 50% would make money, 50% would lose money. At least then half the people would make some money. Remember that research, 80 to 90% of people lose the lot. Tells you day trading is a terrible idea. Don't do it. Please don't do it. I want to talk about compounding, and we've just done that, right? But here's the real power of compounding. And it expands out in 2 different ways. First, the longer you do it. Second, the better the return that you can get. And I'll share some information. This is Warren Buffett's company, Berkshire Hathaway, owns some shares for the record. I should disclose, I always try to. He's been doing it now since I've got it in front of me here, 1965. That's a long time ago. I get it, right? 60 years this year. So firstly, time. Secondly, the return. So 60 years, keep that in mind. The S&P 500, the predominant US market exchange in the US. S&P stands for Standard & Poor's, name of a publishing company. 500, the biggest 500 companies. It's actually 503 in the index right now for reasons that are best known at S&P, but call it 500 odd companies. They've increased in value. I mentioned 9% before. Turns out since 1965, in US dollars, the US stock market has gained 10.4% per year over that period of time. It's pretty good, right? A bit more than the average I mentioned before. Maybe the future is better than the past. Hopefully, that'd be great if it was. Maybe the near term is better. 10.4%. You do that for 60 years. So 10%, 60 years, 600%, right? No, it doesn't work that way because it compounds. Now, let's do the maths very quickly. Let's say you make 10%. In year one, your $100 goes to 110. You made $10 profit. The next year, you don't make another $10 because you're making 10% of the 110. So you make $10 in the first year to 110. Next year, you make $11. Now you're 121. The year after that, you make $12.10. So you're $133.10. Next year after that, you make it $13.31. So now you're at, and so money is making money. The curve starts off nice and flat, but goes really quickly up that way, right? So 60 years of 10% is worth, get this, 39,054%. That is 390 times your money. Now, Buffett, pretty good at this caper. I'm not Buffett, you're not Buffett. He made 19.9% per year on average over that period of time. So just about double, not quite double. So the market was 39%. Okay, we know that we can't just multiply. Maybe you can double the 39,000% and maybe you made 78,000%. That'd be a very, very, very good result. In fact, no, compounding works not only by year, but by return. So not only did Buffett get more than the market, a little bit less than double, instead of getting 39,000%, you have to stay off this one, 5,502,284%. In other words, Buffett made 55,000 times his money. 55,000 times in 60 years. By doing what? Well, Buffett was investing at the time. This isn't Buffett's money. This is shares in Berkshire Hathaway, the company he owns. If you'd bought those shares when he bought them, and again, put them in the safe, put them in the vault, gone fishing, done whatever, maybe you're not even around then. Maybe the grandkids or the kids have got the money. But 55,000 times your money. $1, $55,000. $10, $550,000. $100, $5.5 million. Now, I'm not saying it's possible to keep doing this. This is about understanding the opportunity that we can get as investors. And most importantly, understanding the value of compounding. That's what that's about. How we go, Jenny? Will these webinars be recorded for later viewing? I believe so, Jenny. Yeah, I think YouTube record them and they're available. You can play them back straight away. So I hope you'll hang around. But if you can't or you won't, that's completely cool. Maybe you want to skip me making jokes or something else, or watch me. See, I would say watch me at 1.5 speed. I'm told from our podcast listeners that the podcast we do, Motley Fool Money, is the only one they can't listen to at 1.5 speed because I talk fast. So my apologies. You might have to listen to it at normal speed. But yes, you should be able to use the same link you're watching now and view the video. There may be a delay when it kind of processes. I don't really know, but yeah, they'll be available. So whatever link you're using now, bookmark that, mark it as a favorite. Subscribe to the channel if you wouldn't mind. While you're here, can you hit the like button just under me? I know all the YouTube cool kids say like and subscribe, smash the like button or whatever they say. This just, yeah, if you hit like, if you're enjoying this, that'd be really useful. It'll help people find tomorrow's session and also find a replay of today's. And if you want to subscribe, YouTube will send you a notification. Say, hey, the next one's about to start. So yeah, like button, subscribe button, they're under me somewhere. You'll get it. You know, you're smart people. I want to talk about some common financial myths to wrap us up. We've got 15 minutes left. Thank you for sticking with me, by the way. Again, any thoughts, comments, feedback, suggestions, please drop them in the chat now, either for today or for future sessions, so I make sure I'm addressing your issues and concerns if they're relevant to what we're talking about. If it's your football team, I can't help you. I'm a Roosters fan. It was a very bad weekend, so I'm going to talk about finance instead. All right, first big myth. We started talking about saving. We talked about how much you can save, what you can do. Thanks, Jenny. What you can do with your money, right? Here's the big one. Now, we are not affiliated for us at all with CommSec Pocket or CommSec as a business or CBA as a business. In fact, I think the shares are overvalued. That's a different conversation. They've got an app and lets you invest in 8 pre-mixed investment options. You can invest for as little as $50, and the cost is as little as $2, right? So for $50, or probably 52, I suppose you might need to add it to it. $52, you can make your first investment. Really, really, really simple. The app is really easy to use. Sharesies, great platform. I'm not associated with those guys either. You can buy fractional shares. I don't know how little the first transaction is, but it's not particularly big. There's other Pearl's another broker I like. I really like them. I've got an account with those guys and ComSec for, again, full disclosure. They don't get anything out of it, so no need to disclose it, but I will. And Sharesies, by the way, all three. So they're the three I use. One for my young bloke and two for us. Pearl is great. Same thing. You can start with really, really, really small amounts of money. It's worth adding up if you can. I mean, if you can put aside an amount every week, every month, and get more than that, that's even better, right? But you don't need to get rich to start. Here's the other thing. If you're using small amounts of money, the mistakes are cheaper and the risk is less of simply screwing it up. Now, I'm not saying you will screw it up. What I'm saying is if you're worried about, but what if? I don't know what I'm doing. It's all too hard. What do I start with a small amount of money, right? That way it lowers your own psychological tolerances, your own psychological fears of, if you're making me say, right, I'm going to start investing with $1 million, press one button and hope it works, that's freaking me out, right? If I can start with $50 and $2 worth of brokerage, or whatever the other guys trade, it's not going to be that much more than that. It might be $100, $200. You can get started with really, really, really cheap amounts of money. Almost every broker lets you trade with as little as $500. So if you don't like those ones, I'm not saying you should like them. I use them, I like them, but no skin in the game. I don't care if you use someone else. Have a look around, see what you can find. But yeah, you can start with really, really, really small amounts of money. Again, I know money's hard to come by, right? Saving's not easy, but you can start with small amounts of money, and it lowers the risk, because whatever you do that first time, I should disclose, when I started investing, I didn't have the benefit of an Australian Motley Fool or similar, and I listened to an old boss of mine who was a mate, gave me terrible advice. I bought some rubbish during the dot-com boom. I've been there, I made the mistakes. If I'm any use to you, it's because I've been there, done that pretty much across the board. I haven't ever day traded. I was smart enough not to do that. But I bought some rubbish stocks. I sold too early and bought too late and held too long and held I've made all the mistakes, hopefully. Most are in the past now, and we're going to get on with it from here. But yes, please don't let the bigness of the first investment put you off. Please just get started, because that's really important. Again, I started by saying the journey of 1,000 miles, right? Take the first step, really, really important. Second one is, so my old man, when I was a kid, used to say, now the stock market's a casino. And I've written about this before. I don't blame him. Why? Because all you see is, back in the day, Alan Bond, Christopher Skase, the market going up and up and up and up and up for seemingly no reason. It's talked about on the weekend. The smart money's got, the inside running. It's all just gambling. It's all just carrying on. Why would you bother? The market crashes sometimes. I was at school during the '87 crash, and I don't blame my dad. He was a fiery, right? He was a really smart guy, really good man, but didn't have any background in investing. So it was just too foreign. And by the way, it's become a whole lot more available since then, because brokerage has come down. The internet was invented. That's kind of a big deal. Much more accessible, much more democratized these days. But yeah, it feels like that, right? It feels like it's a casino. You have to be smart to do it. You have to know somebody, or only the smart money wins. I'm here to tell you that's absolutely simply not the case. Now, can investing be risky? Yes, it can. I'm not going to sugarcoat this one. If you do it badly, it can be risky, like anything. I don't know anything you can do that if you do it badly isn't risky. Don't give yourself a paper cut if you're not careful. So investing badly can be risky, but don't let that put you off. Do make a point of listening on Wednesday. When we do Practical Investing 101, I'll touch on some of that stuff. But please don't be fooled into believing that only super smart people with inside knowledge, people with a lot of money can invest. Everybody can invest. My young bloke's got an account I'm doing for him. There are a lot of people, and I'm not going to name names or family connections or other things, other than to say there are investors out there who are doing their thing. You don't have to be a Rhodes Scholar. They're smart people, though. My point is, don't fall into the trap of believing that people like you can't do it. Whoever people like you are can't do it, right? You don't need domain expertise. Help, but you don't need it. You don't need a lot of money. You don't need to have know a stockbroker. You don't need to have the inside running. You don't have to watch Wall Street 15 times and taking tips from there. Investing is available to all of us, can be accessed more easily than ever, at lower cost than ever, and you can take the advantage of some of those gains I've just talked about. I firmly believe my entire net wealth outside my house and a couple of used cars is invested in the stock market, right? My money is literally on it by definition, not just as a turn of phrase. My money is that the market will create value, and you don't have to have special knowledge to get in on the inside. I want to mention the debt question, and I really, so I've said all that sort of stuff. I have talked about risk. Here's a real myth. Debt is risky. Debt can blow up your portfolio as easily as it can blow up your investment portfolio and property, right? If things turn the wrong way, it can cost you. Please, 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 please don't use debt to invest. I mentioned greed and envy and other things for desperation. It's true. If you use debt, you can magnify your gains. Absolutely. And you'll see the stories. This is the other problem. The newspapers don't report the guy with 138 properties that goes broke. They report the guy with 138 properties who's on the front page of the paper saying, look at my investment portfolio. Oh, I leveraged up. I used the bank's money. I'm a really smart guy. That's true until it all comes crashing down. I spoke to a bloke not long ago who was forced to sell every investment property he owned during was it GFC? I think it was GFC, and walked away with zero. Actually, less than zero. He owed bank money. Those properties might have played out well, frankly, after we know what happened since then. Why didn't it? Because he took on debt and the bank held the whip hand. Please don't use debt to buy investments of any sort. If you have to do it for investment property, I guess do that. But seriously, the risk, the additional risk you're taking, very, very rarely worth it. You're better off compounding your savings than trying to get too clever with debt. Warren Buffett said leverage is the only way a smart guy can go broke. I reckon that's pretty true. So be very, very careful. Some debt is okay. Housing debt is great. HEX debt is great. Why? Housing gives you shelter. HEX gives you income potential. I'm not going to say all debt is bad. Consumer debt is atrocious. Don't borrow for a car if you can avoid it. Buy a cheap one instead. Don't put stuff on credit cards. Don't borrow to go overseas on holidays. Don't use Afterpay. They're just trying to get you to, they're taking advantage of you, right? I want it now. I can put on the debt, worry about it later. I get it. I've been there. Don't do it, please. It's bad. I'll tell you my car story maybe later in the week if you ask me nicely. The other thing is, I think, and this is a positive one, I suppose, in some senses. There are people, there's a story in the Fin today about how low superannuation balances are right now for a lot of people. Now, it's not a particularly useful story because they talk about today's 70-year-olds to make the point that super is not useful. Problem is today's 70-year-olds didn't have super when they started working. And they first got it was 3% of their salaries. And then it was 6, and then it was 7, and then it was 8. And it wasn't, by the time you get to the end of your retirement, you haven't enough time to compound a large enough amount of money. Kids who start work today, we'll talk about super later in the week. Kids who start today are getting super at 18. Hopefully, by the way, younger. There's some push to try and change it to everyone working. If you get super at 18 at 12% of your salary, and then at 21 and 23 and 28 and 32 and 35, and then do that for your whole working career, you'll be completely fine. But what I want to, I guess, if you're not in that situation, you're probably someone who is saying, I want to save and invest for my retirement. I can't promise you, as I said at the beginning, $1 million by retirement. What I can promise you is that I will help you understand the way I think you could go about investing. I can't promise you the returns. I said that before, but I'll talk you through how I think you can build a portfolio to give you long-term success and why it's worth doing. People, again, why is this a myth? The myth is, I can't get this, I'm not going to try. And I get it, right? What's a great analogy? I don't know. I can't run a marathon, so I'm not going to bother walking out the front door. I can't walk to Sydney, so I'm not going to walk to my next suburb. The key thing here is to, anywhere you go, investing wise, is better than where you are. I can't. Now I'm retired. Sucks. I can. Gee, I'm not retiring as much as I thought I could, but gee, I'm much better. I'm glad I started. That's worth doing, right? That's worth doing. So don't get put off with, I can't have, every kid wants a pony, right? And every kid gets a pony. But everyone can have an investment portfolio of a relevant size to how much they can put in, how much they can earn, how much time they've got left. Really, really, really important. Last thing I want to talk to you about is the way of, there's a thing called buy to hold investing. And you will see plenty of people, this is kind of half myth, half not. There's a group of people investing who say buy to hold, buy and hold is the answer. You buy something, you hold it forever, and eventually you make money, right? That's sensible because it's long term, it's patient, it's disciplined, all the things I just talked about. That's really worthwhile, really useful. Go and do that. The other people will say buy and hold is dead. If you're bored for 15 minutes, type in buy and hold is dead in Google, and you'll see articles written 3 years, 5 years, 12 years, 15 years, 25 years ago. By the way, it hasn't been true because we've seen the results since, but it's always tempting, right? Buy and hold is dead. Because why? Because the market is more sophisticated, because there's computerized trading, because of Bitcoin, because of whatever, right? The GFC, COVID, buy and hold is dead. I don't subscribe to either of those theories. And they're both myths in my view. What do? I'm in the middle. I buy to hold. I buy with the intention of holding forever. There are companies in my portfolio. I mentioned Berkshire Hathaway. Warren Buffett's company in the US. I hope my kids inherit my shares in Berkshire Hathaway, right? Not because I'm a Scrooge McDuck squillionaire and I can afford not to need any money in retirement, but it's one of those companies I think will do really well for a long time. Maybe I sell some on the way for income, but I hope they inherit those shares. I'm buying to hold, preferably for decades, but I'm not holding regardless of what happens. if Berkshire's involved in some horrible fraud and it's all awful, I'm not going to keep the shares just because. If I'm offered a bajillion dollars for the shares, am I going to hold them and say, well, no, they're not worth that, but I'm not going to take your money. I'm going to take your money. Same as my house, right? Some companies, I'll give you $15 for your house. I'll say no. They're all going to say, I'll give you $5 million for the house. Oh, I'm taking that money. I'm packing for them, right? I'm helping them move in. But buying to hold is what this is all about. So the myth of you must buy and hold no matter what is not good. Buy and hold is dead is stupid. Neither of those things are useful or real. Depends what you own. Depends when you are, how much it's worth. Depends how long you own it. Depends what your goals are. All that kind of stuff. But don't believe you have to have a view. This is the other thing, right? Ideologues are very rarely good for us in any facet of life, including in investing. What's appropriate is being pragmatic, being evidence-based, letting the data drive your decisions, doing the things that work, that pragmatically have and do work. Yeah. John Maynard Keynes famously said, when the facts change, I change my mind. What do you do? And think about our politicians, right? Accused of backflipping. I said, well, wouldn't you want them to if they come up with something better? I have a view on a thing. My view is no longer that because I've learned more new things. What should they do? Should they change? Or should they stick and say, well, I said this thing when I was wrong, but I'm going to pretend I was right and keep saying it because why? Because I don't backflip? It's crazy, right? So do what's right at the right time for the right reasons, preferably based on evidence. That's it for mindset and myths. I hope I've given you something to think about. I hope I've given you a way to start to process what that is. My homework for you, I have homework every day. My homework for you is think about your mindset towards money. Think about those things that are stopping you making decisions or taking actions and really interrogate them. And I know it's kind of, some of us don't look like I don't like looking inside myself because I don't always like what you see. But really ask yourself, those things you always talked about, the myths and the, the ideologies, the things that just really, I think this about money. Really, why? I can't invest. Why not? It's only for rich people. Really, why? Those things are really, really important. I need to day trade. I need to have the fastest computer. I need to know this and do this. Remember the hospital janitor in the US. Remember the average Australian who invests through super. Again, we'll talk about super later, but the growth of super. We have the 4th largest retirement savings pool in the world. And we're 27 million or 28 million people. Right? Why? Because compounding works. Investing works. You can do it for yourself inside and outside super, as one of our questions asked earlier. It was Dave. Dave asked earlier. You can do it inside super as well. We'll talk about that later in the week. Hey, please come back this time tomorrow, 12:30 p.m. Australian Eastern Daylight Time. You will get a reminder if you hit the like button and the subscribe button. Remember, you've got to do that and subscribe. I think you might have to choose all alerts. Oh, you press the bell. The bell says all alerts, I think. Anyway, I'm clearly not a YouTube native, am I? Click on the bell and then choose alerts. It might be all alerts or important alerts or something. Choose all alerts. And tomorrow, I think it'll come out about half an hour before we start. So if you're on the Eastern Seaboard and you're not in Queensland, that's 12:30 Eastern Daylight. If you're in Queensland, it's 11:30. You can do the maths around the rest of the country. You're used to it by now. There's God knows how many time zones. But thank you for spending an hour with me. I hope you've got some value out of it. I've been a bit passionate. I've been a bit, probably talked too fast. We've put a lot of content together for you for the next 4 days. I'm really looking forward to dealing with it, sharing it with you, and then answering your questions. Have a wonderful afternoon. Enjoy what's left of today. And until we speak tomorrow, full on.